Van Eck funds came out and said if the dollar really did lose reserve status, we could see gold at 139,000 an ounce. So put it into that theory. Right now at $4,000, a $20 million bond in 20 years is 5,000 ounces. At 139,000 an ounce, it's 130 ounces. Now, again, it's all hypothetical, but by letting gold go higher, you devalue the dollar to reshore manufacturing, to build out manufacturing if you have zero coupon bonds, no upfront borrowing costs. And over time, as gold goes higher, the dollar goes lower, our manufacturing starts to build and we can start to produce more than we consume. The rising price of gold speaks to the devalued dollar and makes it much easier to pay off the bond in the future.
The global financial system is rapidly approaching a critical tipping point as mounting national debt and dollar devaluation threaten long-term economic stability. Industrial capacity continues to decline, while exploding unfunded liabilities push traditional monetary systems toward systemic default risks. Andy Schectman, a prominent precious metals strategist and financial executive, asserts that the U.S. government will execute a quiet soft default on its world reserve currency status to re-industrialize the domestic economy. He predicts that gold prices could surge toward $139,000 per ounce, systematically devaluing the dollar to make vast national debt obligations far easier to pay off with depreciated money. From an analytical perspective, this theoretical reset relies on devaluing paper currency through gold-backed treasury mechanisms and zero-coupon bond structures. With national interest costs already exceeding defense spending, permitting precious metals to surge represents the only realistic mathematical escape route from runaway economic collapse. Investors who recognize this monetary shift early will likely see physical gold serve as the primary equity backstop throughout the coming global financial rebalancing. Now, we present the clips from Andy's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
My theory is bigger than what Judy said. My theory was that look, how do you reindustrialize this country? You know, we're 200 trillion in debt when you add the unfunded liabilities. We are uneducated. I talk about Ray Dalio saying 60% of the country has a literacy rate under the 6th grade. We don't make anything anymore. And AI is here to kneecap jobs and automation. And so what do we do? How do we give our children that future? The only way, first of all, because of Triffin's dilemma, that we could indeed reshore manufacturing and have any hope of selling said products to the world would be to quietly abandon the world reserve status. And that was the theory. I mean, the crux of my theory is to quietly soft default on the reserve status. This is why Richard Russell used to say to me, Andy, we consume more than we produce. Therefore, the Fed has two choices, but to inflate or die, default. But the third option, and that's where the previous economic advisor to the Biden administration, Jared Bernstein, wrote a report to Throne King Dollar advocating that we can't be the reserve currency anymore. We've wasted the privilege, and Triffin's dilemma says that, look, the world needs more dollars than we can give them through trade alone. And the only way that they're able to have enough dollars to operate and to buy energy is to, over time, sell their currency continuously in the open market to buy dollars, creating a big discrepancy between the dollars and the other currencies. And over time, manufacturers say, well, let's send our production over there and we'll make 10x. So you end up eviscerating and hollowing out your manufacturing base. And this is a big problem for us right now. We're reliant on China for everything from aspirin to aircraft parts. Can't do that, let alone we have a generation of kids coming up where the prospect of being gainfully employed and the American dream becomes more and more out of reach every day. As prices go higher, home affordability goes higher, inflation is putting prices higher, and we haven't even begun to see the ramifications of this war where you're going to see oil-induced price inflation. We've bled down our strategic petroleum reserves to the lowest they've been in 25, 30 years or longer, maybe 40 years, to mask the effect. Prices are going to go higher. What do we do? So if you were to softly abandon the reserve status, in other words, focus more on building your economy rather than the currency.
Bringing back the manufacturing.
That's how you bring back manufacturing. And how do you devalue your currency? If you devalue it against the dollar index, where currencies are continually selling their currency to buy dollars, it's a faulty measuring stick. You do it by letting gold go to the moon. As gold goes higher and higher and higher and higher and higher, the dollar goes lower and lower and lower and lower. This is where Tether came into it, and the Genius Act, where anytime money moves from January on, it will be backed by stablecoin and 90-day or less short-term treasuries, and that interest is not transferable. So Tether takes that interest and buys gold. They own more gold than anyone in the world, but the central banks bought more than China over the last 2 years. They were in trouble, right, by the Justice Department. Could it be? This is all theory. It's hypothetical. Could it be they struck a deal? I mean, we know Bo Hines was Trump's crypto czar and confidant, is now the CEO of USA Tether, the Genius Act compliant stablecoin. So what if they said, you're going to buy gold with every time money moves and you issue a stablecoin and buy treasuries, you're going to take that interest, you're going to buy gold. You're going to sell it to the treasury quietly over time. You'll all get rich. You're not in trouble anymore, and you're going to help us devalue the dollar and push gold to the moon. This is why Van Eck funds came out and said if the dollar really did lose reserve status, we could see gold at 139,000 an ounce. So put it into that theory. Right now at $4,000, a $20 million bond in 20 years is 5,000 ounces. At 139,000 an ounce, it's 130 ounces. Now, again, it's all hypothetical, but by letting gold go higher, you devalue the dollar to reshore manufacturing, to build out manufacturing if you have zero coupon bonds, no upfront borrowing costs. And over time, as gold goes higher, the dollar goes lower, our manufacturing starts to build and we can start to produce more than we consume. The rising price of gold speaks to the devalued dollar and makes it much easier to pay off the bond in the future. That's my theory. I added this into what Judy said. Now you put it all together. I don't see a better way of doing this. If the world sees that we're trapped, who buys the treasuries to finance the debt? We have like 15 trillion in debt that's coming due over the next 12 months. How the hell do you pay that off? How do you do so? And in a rising interest rate environment, the cost of your indebtedness goes up exponentially. We have already crossed the Ferguson line, which says when a superpower spends more on interest than on national defense, you cease to become a superpower. These are scary thoughts, but the reality of it, it's just mathematics now. And how do you get out of the math? That's why you let gold go to the moon, to devalue the dollar, peg it to a bond, and let the appreciating gold be part of the bond distribution down the road. If you knew gold was going higher in dollar terms, it's a great deal for the bondholder. It's a great deal for the US government. It works out because I do believe in my soul, when you see the most well-informed traders in the world buy gold, that the way they're doing and lying about it, remember what we said? The World Gold Council said, yeah, I understand you guys bought more gold than that being the central banks, that over the first quarter than in any first quarter in history, but you lied about it by a factor of 15. You didn't buy 16 tons, you bought 245 tons. So they're lying about it, as is China. Goldman Sachs said they underreported it by 10 times. So they're lying about their acquisition for a reason. They're using the suppression of paper to accumulate. If you look at what's been bought since the beginning of the year when gold and silver got its ass handed to it, China's bought more than ever. Poland says they've used the pullbacks to buy more. They bought more than anyone but Tether, except actually bought more than anyone, Tether, second to them. Look at the US government, if they're the ones doing this. Or let me just say that differently. Look at the deliveries on COMEX. And if it were the US government and the Exchange Stabilization Fund, Tether would keep them at arm's length on that side. Who's standing for delivery for billions every month? 14 billion in June, 20 billion in February, billions every month. Some of the naysayers say, but yeah, it's not leaving COMEX. Some is, a lot staying there. Well, if it was Besant and the Exchange Stabilization Fund, he could say to COMEX, just leave it there so we don't rattle the bushes. We'll slowly take possession of it, but leave it there. Does he worry about a COMEX default? No, it's the U.S. government's goal. Give it to me first before anyone gets paid. I'm saying that show me a better way to get out of the problem we're in and look your grandkids in the face and say, you too have a future. How the hell do young kids have a future in this environment that's only getting tougher and the dollar's becoming less desired? Interest rates have nowhere to go but higher unless they're manipulated lower, which is monetization, which leads to hyperinflation. We're trapped. We can't lower, we can't raise. So what do? You got to think outside the box. That's what I did. And I added a little bit of a caveat to what Judy said, and I still think it's the best idea I've ever heard.
Central banks and global superpowers are secretly accumulating physical gold at historical rates, while drastically underreporting their true purchase volumes. Heavy physical deliveries off commodity exchanges prove that institutional capital is quietly exiting paper derivatives in favor of vaulted physical bullion. Concurrently, the BRICS coalition is establishing dedicated agricultural and precious metals exchanges to dismantle Western price discovery monopolies long held by hubs in Chicago and Paris. Representing nearly half of global grain production, these emerging sovereign blocs will settle cross-border trade imbalances in physical gold rather than depreciating paper currencies. This structural shift indicates a permanent decoupling between paper spot markets and physical delivery premiums. From a strategic perspective, as physical gold drains from Western vaults, paper derivatives will lose market credibility, establishing physical bullion as the dominant benchmark for international commerce. Now, let's get back to the interview.
So let me tell you a few of the things that are happening with BRICS and keeping Enbridge in mind. First of all, the BRICS agricultural ministers formally reaffirmed plans to open a BRICS grain exchange. And Putin and one of his advisors were talking about this not too long ago. And the advisor said, look, we accumulate, we produce and consume as much or more grain than they do in the West, but we don't control the price. But that will change with the implementation of the BRICS grain exchange. It is finding an alternative marketplace for grain trade. And these, again, alternative marketplaces from the Western system, paying in local currencies over things like Enbridge, settling imbalances in gold. Russia says the exchange has moved into the design phase. Its officials announced that a conceptual operating model has been completed, and a BRICS task force has been established to study the grain markets and recommend how the exchange should operate. Again, the bigger story with this, to me, is similar to what we see in Hong Kong with their new metals exchange. It's price discovery. It's price discovery outside of a Western system that has ruled the world forever. And forever, Chicago and Paris, as it pertains to grains, have ruled the world here. That's going to change with the BRICS bloc representing almost 50% of global grain production and consumption. Few other things that are important. BRICS Pay is moving forward, and that might be the biggest story of all. The payment network, it's supposed to be a massive agenda in the September BRICS summit. Now, I saw an interview with the gentleman who has created BRICS Pay, and they 2-3 months ago were already in negotiations with the Belt Road Initiative, all of the countries within the Belt Road. That's 75% of human population. BRICS Pay is the ability to settle trade directly in local currencies, bypassing SWIFT with a credit card or an app. It's the B2B, it's the consumer to business. Enbridge is central bank to central bank. This is B2B. So, we've already talked about the grain exchange. They also confirmed, Russia did, that they're working on a BRICS precious metals exchange to create alternative pricing for gold and silver. Similar to what we're seeing in Hong Kong, similar to what we're seeing same-day settlement in Singapore and United Arab Emirates. Only difference is those two are in dollars. Hong Kong is in yuan. This will be in currencies other than US dollars, and settlement systems other than US dollars. And when you realize that what they're going to do in September is focus on commodity exchanges, digital settlement infrastructure, expansion of local currency trade, and further financial integration amongst members, this is a trend that is increasing. China, by the way, this is a story that people probably haven't heard yet. A dig for this one. They signed a deal with Africa's largest bank, the ability to settle trade directly in yuan. That's important because China is already Africa's largest trading partner. Now, remember the CIPS. China signed up the countries in Southeast Asia for the CIPS network. It allows them to trade with one another in local currencies, settle imbalances in gold. The same thing will happen here. They will trade across the CIPS network. And remember, what did China do in Hong Kong? They made gold priced in yuan. So if China buys whatever commodity from Africa and pays for it in yuan, Africa can say, I'll have gold, please. Thank you very much. And so what you are doing is bypassing settlement in the US dollar. And when you talk about not trading as much in dollars, that means you don't need as many US treasuries. Correct. And instead you own gold because that will be the de facto settlement vehicle for imbalances in currency and in trade. These things are accelerating behind the scenes quietly. And this is the kind of thing, the acceleration of this, that isn't stopping. And although it doesn't happen instantaneously, and we live in a world where instant gratification ain't fast enough, if you're not paying attention to this, you're missing a very important trend, because we'll all wake up one day and something will be like, whoa, look at this. It's fully established between rails, between payment systems, between trading imbalances in gold instead of US treasuries, setting prices for the world's commodities in different currencies on different exchanges, and really bypassing the entire Western system little by little by little until it just becomes, the critical mass kind of thing where the scales start to tip. So look, even China doesn't want a rapid move away from the dollar. That would harm its own balance sheet. But that's not the point. The point is that one trade agreement, one payment system, one currency settlement, all of these things began to build a more of a multipolar system, which is what they're trying to do. And, de-dollarization isn't an event, it's a process. And that's the point I think that we want to talk about more than anything. And if it were a word, I would say de-treasurization is the same thing. And you can see that by the dollar going down and the yield going up on the long treasury, countries are selling treasuries to push the rates up, even though the Fed isn't raising rates. These are all little signs that begin to point in a direction that if you save and hold your wealth in US dollars, you're holding a melting ice cube over time.
Next-generation payment networks like BRICS Pay and China's CIPS system are rapidly bypassing traditional SWIFT channels to settle international commerce directly in local currencies. Direct trade agreements across Asia and Africa allow sovereign nations to convert commercial revenues straight into physical gold, eliminating the need to hold US dollar reserves. This evolving financial architecture accelerates an irreversible wave of global de-treasurization as foreign entities systematically dump long-term US Treasury bonds. Consequently, sovereign borrowing yields will continue surging upward regardless of official central bank rate policies. From a broader macroeconomic perspective, this structural shift presents a severe dilemma for Western monetary authorities: allow interest rates to rise and trigger widespread economic debt defaults, or monetize national debt through unchecked currency creation, directly unleashing hyperinflation. Having already crossed the critical Ferguson line where debt interest costs exceed national defense budgets, saving wealth purely in unbacked fiat currency will prove disastrous as purchasing power steadily erodes like a melting ice cube. Tangible commodities and physical bullion will inevitably serve as the ultimate neutral reserve assets in the emerging multi-currency world order. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.